of future returns. Before investing, always seek the advice of a competent financial professional. Welcome to Profitable Strategies for Savvy Stock Market Investors with Toni Turner. Toni Turner is the best-selling author of A Beginner's Guide to Day Trading Online, A Beginner's Guide to Short-Term Trading, and Short-Term Trading in the New Stock Market. A stock market trader and investor with more than 14 years' experience, she's a popular educator and speaker at financial conferences and trading forums across the U.S. Toni has appeared on NBC, MSNBC, CNN, CNN-FM, and CNBC's Power Lunch. She's been interviewed on dozens of radio programs and featured in CBSMarketWatch.com, Fortune Magazine, and Bloomberg Personal Finance. Learning how to invest in today's financial arenas can appear as an overwhelming challenge. Toni is known for her unique ability to explain the sometimes complex workings of the stock market to traders and investors in a way that makes it accessible and easy to understand. In this session, she'll offer 3 basic approaches to investing in the stock market, along with additional strategies for investing success designed to minimize losses and maximize gains. And now, please join Toni Turner and learn profitable strategies for savvy stock market investors.
Hi, I'm Toni Turner. Today we're going to talk about profitable strategies for today's savvy stock market investor. If you'd like to view this presentation on the internet in PDF format, all you need to do is go to www.toniturner.com/investor. There are lots and lots of benefits to investing in today's stock market. Investing wisely has proven to be one of the most lucrative ways that you can increase your wealth. When you choose wisely, when you choose with care, your stocks can make you money while you're out on your boat, while you're enjoying life, while you're working, spending time, doing other things. There are many different styles of investing, one for every personality, one for every lifestyle. You can get into volatile stocks. You can get into stocks that move quickly. You can get into stocks that move slowly. Whatever your personality is, whatever your lifestyle is, you can find a stock that will benefit you and your investment needs. It's very, very important to take control of your own financial future. You know, I was in a cab a few months ago in New York City. I was going to a trading expo, and I saw a billboard on the side of the street. It said, "Spend quality time with your money." And I thought, wow, what a cool thing to say. How often do we think of that? We spend quality time improving our homes, quality time improving our companies, quality time hopefully with our families. And then a lot of times we take one of our most important, one of our most precious assets, we give it to a stranger, and we hope it will grow from there. We need to invest positive energy into our financial future. During the next few minutes, we're going to talk about 3 approaches to investment success, 3 different aspects of the market that you're going to want to look at before you invest in a stock. We're going to learn how to evaluate the stock market environment. It's not that difficult to do. You can access the resources right in your own home. Next, you're going to learn how to evaluate your target company's fundamental data. Now, this kind of sounds complicated to a lot of people, and it can be a lot of work. If you don't have time to do it like that, it's okay. I'm going to show you some ways that you can evaluate a company's fundamental data, and it's important to do so, taking some shortcuts, what I call fundamental one-a-day vitamins. You can access the information quickly, easily, and it can be from very high resources. Finally, we're going to learn how to evaluate your target stock's health right now on a simple price chart. This is called technical analysis, and although a lot of people think, wow, that sounds really difficult to me. Again, I'm going to show you a simple way to tackle technical analysis so you can see where a stock's been, where it is right now, and where it might be going in the future. Let's evaluate the stock market environment. Let's look at different ways to evaluate if we're in a bull or a bear market. How do we find out, as busy as we are, where the economic markets are, where the financial markets are today? How do we know? Let's take some vital several things into consideration here. Everything in our universe, whether it's the planets, whether it's the seasons, whether it's the tides, whether it's crops, even we ourselves as human beings, everything moves in cycles. The financial markets are mainly dictated by interest rates. And what are interest rates? They sound complicated. Interest rates are merely the cost of money. Interest rates is how much it costs you to borrow a chunk of money for a given time and then pay it back to the person who lent it to you. The cost of money is one of the biggest economic factors there are in moving economic markets. When interest rates go up, it costs more to borrow money, and that impacts a company's bottom line. When interest rates move down, obviously it doesn't cost as much money to borrow money. The stock market generally runs at about 3 to 6 months ahead of the business cycle. There are two cycles, the business cycle and the stock market cycle. The stock market cycle runs about 3 to 6 months ahead of the business cycle. This is where sector rotation comes in. This is where you see oil moving up, airlines moving down, drug companies moving up, maybe basic materials are running up. It's not that hard, and it's kind of easy to do, but it's important when you get into the stock market to focus on the sectors and the industry groups that are in favor in the current market environment right now. And you say, well, Toni, what if I buy in a group that's favorable right now and it isn't in the future? It's okay, because you don't want to get into an industry group or sector that's moving against you right now so that you have to make the money up that you've lost from it moving down in the beginning. We're going to look at sectors and industry groups that target the market, and I'm going to show you how to target leading stocks and leading industry in the current market environment. There are two basic types of analysis, fundamental analysis and technical analysis. We use these two different kinds of analysis and combine the information in order to make a decision as to whether or not we want to invest in a company's stock. When we look at a company's fundamentals, we're looking at such data as price to earnings ratios, earnings per share, market share, what share of the market does this company have, and an overall view, return on equity, return on investment. We also may want to look at such things as what kind of new products does the company have coming through the pipeline, what kinds of new services do they have coming through the pipeline. This is very important to get an overall view of a company's bottom line. The other kind of analysis that's used quite a bit and that's coming more and more into favor is the analysis that traders use. I myself am a trader as well as an investor, and I like to look at a picture very, very quickly, very, very fast, of where a company's or a stock's price has been relative to where it is right now in the current market environment. The price history that you can see on a chart during a given time period gives you a tremendous amount of information, and many times quite a bit of predictive power to see where it may go in the future. This is how we tell where bull and bear markets are. This is how we tell how far a company has been. Maybe it's just starting into an upward momentum pattern. Maybe it's come down in a downtrend, based out, and is starting up now again. It's very important to know, like with anything else in your world, where a stock price has been, where it is now, which gives you predictive value in knowing where it may go in the future. Before you buy a stock, you'll want to evaluate your target company's fundamental data. These resources will tell you which ones are strong right now, which ones are weak. That in turn leads you to look at the stocks or the components within these industry groups, and the rankings will help you evaluate which stocks you want to get into right now that have future growth ahead. It sounds like a complicated thing to do, but I'm going to show you some ways to make it easy. I'm going to show you some resources you can go to in order to evaluate a company's data quickly and easily. You know, when we go to Macy's to buy a red blouse, if we only have a certain amount of time, it's not wise of us to spend our time looking at blue blouses or brown blouses. We only want a red blouse. This is kind of the same thing. We only look at the stocks, we only look at the industry groups that can benefit us right now, that make really wise investments, and that will carry that momentum into the future. So don't look at blue blouses if you only want a red blouse, because that's wasting time. That's not effective. That's not efficient. You don't want to spend all your time. You don't want to spend all of your time researching stock fundamentals. But we have more to look at here that you need to spend a little time on too. Companies that rank stocks according to highest to lowest rankings are companies like Investors Business Daily. Investors Business Daily is great because it has a number of rankings or ratings right next to the Smart Select Composite rating. The rankings go from 100 to 1. So possibly if you're looking for a stock to buy, you'd like to buy a stock with a ranking of 60 or 70 or higher. That makes sense to me. Morningstar is also a very good resource, and they have a great ranking system. They rank stocks with stars from 5 to 1, 5 being the highest ranking, 1 being the lowest ranking. The final ranking system that we're looking at here is ValueLine. You can go to valueline.com. ValueLine ranks stocks from 1 to 5, 1 being the highest rank and 5 being the lowest. Ultimately, these three resources will streamline your research. They will help you be efficient and effective when you're researching your target stock's fundamental information. And in today's hectic world, that's a very valuable asset to have. And certainly other large newspapers and financial newspapers also give you information about current industry groups that are doing well, that are in bullish modes right now. Sectors are like technology. Sectors are like healthcare. Those are sectors. Within those sectors, there are industry groups such as pharmaceuticals, such as medical equipment, such as biotechnology stocks. These kinds of resources will give you information as to whether these particular industry groups are right now in uptrends, are strong, are weak, where are they in the positioning of the bull or bear market that you're experiencing, that we're in. Once you find the industry groups that are strong, and maybe it's transportation, transportation being a sector, maybe it's airlines, maybe it's trucking, but these resources will tell you which ones are strong right now, which ones are weak. That in turn leads you to look at the stocks or the components within these industry groups, and the rankings will help you evaluate which stocks you want to get into right now to have future growth ahead. Technical analysis is the study of historical price patterns over a given period of time. As you're going to see on the screen right here, we have a weekly line chart of ExxonMobil. The ticker symbol for ExxonMobil Corporation is XOM. The data on this chart was plotted from October 2003 to October 2005. Now, a line chart is just that. It takes into consideration the closing prices of every single week from October 2003, in this case, to October 2005, and it draws a line, just one simple line, from the closing prices each Friday night of ExxonMobil Corporation. Line charts are easy to read. You don't have to look at bars. You don't have to look at other different technologies such as candlesticks. The line alone can tell you, is the price going up, is the price going down, or is the price going sideways? As you can see with ExxonMobil right here, this stock was trading and the price for the stock is in the right-hand column. If you look left, all the way to the left axis, you'll see that Exxon was trading right around in the $38 area in October of 2003. Since then, Exxon has moved higher and higher, and we all know what's happened to oil stocks. It made quite a high in March, up near the 64 area, and now it's trading back in the 58 area. You'll notice that it made a steady uptrend. Now, we call an uptrend a series of higher highs and higher lows. And you'll notice that Exxon made a very wise investment from 2003 even now all the way up to the right-hand side of this chart. Think now, what would happen? Is Exxon going to pull back here? Is it going to go lower for years to come? We don't know. But wouldn't it have been really, really wise to buy shares of ExxonMobil back at the end of 2003 and held it possibly to the first of 2005 or even right now? A chart is a simple picture. It's worth 1,000 words. And when you combine technical analysis with fundamental analysis, you get a very, very clear picture, again, of where a stock or a company's been and where it might want to go. There are different kinds of charts. The chart on your screen represents the same chart as the line chart in bar chart format. Each tiny little vertical line represents 1 week. The small, tiny horizontal lines perpendicular on the left are the opening price, and on the right are the closing price. On this chart, we've added an indicator known as a 30-week moving average. We've added this for a reason. Remember back we were talking about fundamental data. We talked about ranking or rating our stocks, and we talked about wanting to invest in stocks that had rankings or ratings of, say, 70 and above or 60 and above. Now we're establishing criteria on charts that we're going to add as another decision support tool. And when we get all these decisions together and funnel them all down, we're finally going to arrive at a buy signal or an ignore signal. And in some cases, as our investment matures, we're going to use it as a sell signal or a take profit signal. Let's go back to this chart. We're going to use the 30-week moving average again as a guideline for buying and selling our stock. First, we're going to go to the market environment. We're going to ascertain whether it's a bull or bear market. We're going to focus in on sectors, technology, healthcare, financial sectors. We're going to look further into those, and with the resources we used before, we're going to find industry groups that we like. Maybe it's banking, maybe it's pharmaceuticals, maybe it's biotechnology stocks or software stocks, or in this case, an oil or oil services stock. Now we're going to move down to our target stock. We looked at the line chart, we've seen where Exxon has been, and now we can look at this bar chart and see if we had bought Exxon back in the last part of 2003, and we could have done it with this price chart had we had access to it at that time. If we bought back in 2003, when Exxon rose, look at November here, look at November, look at the end down on the left side of the chart. If we had bought Exxon when it rose and made 1 or 2 closes above the rising 30-week moving average and held on to it as long as it traded above the rising 30-week moving average, if we had done that and held on to it until it made 1 or 2 closes below the 30-week moving average, we would have made quite a good profit. How can we refine these decisions? How can we get them even closer? Look down at the chart and you say, well, Toni, what if I bought Exxon at 38? And what if it turned around back in November of 2003? And what if it rolled over or pulled back or retraced, as we call it in the market? What if it just fell down to 28? I would have lost a lot of money. This is where your insurance comes in. Again, we put insurance on our homes. We put insurance on our automobiles. We certainly insure our health. Let's never again, let's vow to never again enter the stock market without putting insurance on our investments. That way, if the stock pulls back or it loses value, we get, as we say, stopped out immediately. We can put them in automatically. Now the market's going to do it for you. You can enter a stop loss order with your broker, and you can be at work or at play, anywhere in the world, and with that automatic order is entered, the market will take you out automatically. How are we going to place our stop loss? There are many different ways of doing it, but a really good way for an investor strategy is to protect, once you enter a stock, immediately put a protective stop loss order, again, enter it with your broker, from 7 to 8% of the purchase price, whatever you bought the stock for. Put that order in right immediately after you buy the stock, and that's your insurance. That will take you out. We'll talk about this just a little bit more in just a minute. Here's another example of how we can use price charts and 30-week moving averages as decision support tools to enter a stock and make profits and keep safe. This chart is a price chart of Johnson & Johnson, the big pharmaceutical company. Notice how Johnson & Johnson bottomed out, as we say in the markets, at the end of 2003 and started moving up and moved up all the way through the middle of 2005. Wouldn't it have been great if we'd gotten into this stock back then and ridden it all the way up to $70? Looking at this price chart, you can see how if we had bought Johnson & Johnson when it moved over its 30-week moving average back in the beginning part of 2004, and then stayed in this stock until the first few months of 2005, we would have made a good profit. You say, well, Toni, look what happened here. Johnson & Johnson in the beginning part of 2004 moved up over that 30-week moving average you're talking about. I bought the stock, but then it jumped up and rolled back over and fell through that moving average. Yes, but you put in your stop loss. You put in your protective stop at 7% of $52, your stop is at $48, you're totally protected. Johnson & Johnson didn't retreat to that price point. It rolled over and started right back up again. You were totally protected. Had you not even looked at the stock to see how it was doing, you would have been okay. Johnson & Johnson kept moving up again until March and April of 2005. It did start pulling back. When it fell through its 30-day moving average in May of 2005 and made 2 consecutive closes below that moving average, you would have sold the stock using this criteria. You would have bought at 52 and sold at 65. That's a pretty good percentage profit to make, and a safe one. Above all, remember, we want to preserve our capital. We want to preserve our profits. Okay, now as we're looking at this chart, and I picked this chart on purpose because, believe me, the stock market does not behave. It does not act the way we want it to, and certainly the stocks that make up the stock market sometimes act like a bunch of irrational teenagers. They are all over the map. What we don't want to do is look up one morning and find out that we've lost $10 or 10 points in a stock. We don't want that to happen. In this particular scenario, Johnson & Johnson, when it moved up past that 30-week moving average back in the beginning of 2004 and we bought it, it could have very definitely risen up higher and then pulled back and dropped to our automatic protective stop loss at 48. We have to learn to do one thing with our shoulders. We have to learn to shrug. We have our insurance in. This is the stock market, people. It's getting more and more volatile every day. And if we get taken out of the stock for the price of a few dollars plus a commission, aren't we far more fortunate than if we hadn't paid attention, hadn't placed the stop loss, and had let the thing fall further and further down, and then in essence lost a lot more money, and then had to hang on to it and hope we made it up. I know all of us, myself included, have bought stocks, invested in stocks, ridden them up to big profits, thought we were rocket scientists, and then paid no attention, and in our euphoria let these stocks move all the way back down to where in fact we end up taking a loss. Please believe me, when you're investing in the market, especially as volatile as they are today, especially with the global events we have coming in that are unexpected every moment in time, it's totally necessary to put in our insurance, to put in our protective stop orders. Yes, you are going to sometimes get out with a small loss. Sometimes those stops are going to be hit sooner than you thought they were going to be. But if you think back, your first loss is always your smallest. It's always your smallest. Think back to companies. Think back to people in who invested in MCI WorldCom when it was having problems, who invested in other kinds of companies that have done the same thing. How wise they had been. How wise would have they been if they put their protective, their insurance stop in, and then raised it a couple of times during the course of the stock moving up. How smart would have that been? There would have been far less losses than the trillions and trillions of dollars that were lost on those particular investments. So put your insurance in, and know that while you may get stopped out once in a while, you're going to be very thankful and very grateful that you've done it many, many times over. Now let's look at this particular price chart and see where we could have raised our stop loss points to a couple of times to ensure that we made really good profits. If you can draw a horizontal line, and I bet you can see that the price found what we call support right in the $54 area, right where the bottoms of all those bars are throughout the second half, or right about the middle of 2004. Just draw a horizontal line with your eyes or a pencil, whatever you like. You can see how we're doing it here. And you can see that every time Johnson & Johnson fell down to a particular place, it always stopped right there at that $54 area. A smart thing to do is move your protective stop up to about $1 or so underneath that particular area. So where would we raise it to? We would raise our protective stop to about $53, $52 if you're more comfortable, as soon as one or two of those support areas were formed. This tells you that when this stock keeps coming down to this area, buyers come in, say this is a good price for Johnson & Johnson, and in their buying they hold it up or they support it, and eventually it begins to go higher. Now what were to happen there? If you raised your stop and the stock, as we say, rolled over and went through it, well, the very worst thing that can happen is you make $4 a share profit. That's not too bad, and it's a relatively short time period. When Johnson & Johnson starts back up, if indeed it does, and it did in this case very definitely, you can reinvest if you like. At the worst case scenario, you've made money, and that's not a bad thing in this day and age. What the other thing you've done is something we're going to talk about more in a few minutes. You've protected your asset known as your portfolio. You've protected your equity, and that is the single most important thing you can do in your investment career. Now, Johnson & Johnson moved up for the latter half of 2004 very, very quickly and very, very nicely. When you get more advanced and you become more advanced, you can start drawing trend lines from the bottoms of each of these moves up. And perhaps you want to use these trend lines as your stop area if you want it to get tighter and tighter. However, if you don't, know that many times the 30-week moving average will form a trend line of its own. And we know that we're not going to keep the stock if it makes one or two closes below that moving average. So that in itself is your automatic stop out. Again, Johnson & Johnson fell below our moving average in June or July, it looks like, of 2005, and we've made quite a nice profit. Let's move on to our next chart. Here we have a chart of Alcoa Aluminum, the huge manufacturer. We have another example of how we could have bought Alcoa Aluminum when it rose over. Please keep this word rising in mind. I said it over and over, but it's so important that the 30-week moving average is going in a horizontal direction or at least rising. We never buy when a stock is moving over a falling 30-week moving average. Now, a moving average is just that. It's the average price of a stock over a given time period plotted into a line form. Here's another clue, and something I wanted you to see on this chart. When we're investing in this kind of a way, when we're looking at price charts in this kind of venue, what we're doing here is something you're going to want to study more, is we are buying stocks that have come down in the roller. Remember I told you everything goes in cycles? these big icons of American industry, so do their prices. These stocks have moved up in value, come down in what we call a downtrend, stabled off in the trough or the base of the cycle, and started moving up. What we're doing is we're buying stocks when they start moving up. We're trying to get the biggest reward for the smallest amount of risk. And that's why I'm using this particular indicator. That's why I'm using price charts for my investment. Once you look at price charts, very, very simple ones like these, and study them a little bit, your eyes will get trained, and you're going to start to see how they relate. Such valuable information for you. Pretty soon, when somebody says, would you like to invest in something, the first words out of your mouth are going to be the first words that are out of mine. Let me look at the chart. Now, again, and when you combine that with the fundamental information and the other information that you've kept track of, that you've looked at, you're going to find it to be a very, very, very valuable analysis tool. This is a weekly chart of Alcoa aluminum, a bar chart, just like our last one with Johnson & Johnson. And again, you can see how we use the 30-week moving average as an indicator and a decision support tool. Now, as you can see on this price chart, Alcoa aluminum came all the way down in the middle of 2002, kind of touched off here at $18, moved back up, retested almost, but not quite that, and moved up again over our 30-week moving average. As it moved over this moving average, and this moving average here is rising slightly, we bought Alcoa aluminum at about $23. Immediately, we put our stop loss in at our 7 to 8% point of $21.30. Now we've got that insurance in. Now we know that if anything happens to Alcoa aluminum, it doesn't have far to fall before we're taken out. Notice how we bought Alcoa aluminum at 23, and it ran up to about 26, and then it had to rest for a little while. And as it was resting, buyers came in, increased demand, and moved it up even higher in price. Price charts are human emotions in a picture. They are human emotions. At the bottom of this price chart back in the year 2002, we can see fear. We can see panic. Probably people who have this stock panicked when it moved in a downtrend all the way down. Then as it started up in 2003, you can see little bits of optimism coming into the market. Some people are starting to nibble and say maybe the stock is going to move higher. The optimism will move more and more into greed, different levels of greed. When you see a stock go from here to here, now we're talking about the emotion called euphoria. When you see a stock move in a almost vertically in an uptrend and change the angle the way Alcoa aluminum did, now you want to start raising your stop, if you know how to read this kind of trend, in order to get the maximum profit. And if you don't, it's okay. If you don't, you can wait until it crosses that 200-week moving average line, as Alcoa aluminum did in April of 2004. It crossed over this line, made certainly 2 consecutive closes. We could have gotten out here easily at 34. But remember, I keep using the word close. It did not close below that moving average, and the close is the most important part of the day or the week for any stock. The close is when the commitment's made. The close is when people say, okay, I believe enough in this stock, I believe enough in this company that I'm going to hold it overnight. And after all, time is a premium in any of these investments. The longer you're in an investment, as simply put, the more things that can happen. So let's keep that closing price in mind, especially on these weekly charts. That's a really good information guideline. We bought at 23, got out at 34, and our time frame was just a matter of a few months. Do you see how these moving averages can keep you safe? Do you see how using a criteria, this one or one similar to it, can keep you from taking big losses in the market? Now, stocks will sometimes go like this. There's nothing we can Again, it made little pullbacks. You can move your stop up underneath these support areas. You can see all along this trend line. Now I want to tell you something about trends. Now that you're getting used to looking at charts, look at Alcoa aluminum and look at how steeply it rose between October of 2003 to the end of the year. Notice how it was moving kind of at a 45, well, a little steeper, 50, 60 degree angle. Now just simply look at how that trend changed from October on. Notice how it started to go up ballistically, like a missile. What happens to things that go straight up? Anything in our world, usually at some point comes down pretty hard, right? I want you to look at the final point here I'd like to make about Alcoa aluminum. We know we got out at the price of 34 back in February, March. Notice how Alcoa aluminum pulled back from that area to about 29, did a few gyrations, and right around October, Alcoa moved down. Not $2 per share profit in every share of Alcoa aluminum that you bought. Now let's look at Boeing. This is our final chart, and it's a very beautiful chart, I'm sure. This is a chart that makes every investor happy, especially as savvy investors like we are, because we knew to buy in 2003, and we knew to buy and get in at 31. That's where our price crosses up and over our 30-week moving average. I think it's wise to watch these stocks. I like to catch them before they move through the average, so I can watch and see and get in at the highest precision point. Boeing moved up and over. Now the moving average isn't moving down here when we enter. It's moving sideways, and that's totally acceptable. On this particular example, we would have bought Boeing at $31. Immediately, we put our stop loss in at $29. That's our insurance in case it goes lower, and we're not ever going to move it down. We're only going to move it up as the stock goes higher. Boeing retraced a tiny bit back to almost to our entry price, and it took off from there. We can move our stop up several times on this chart. Now notice, you might have been bumped out of Boeing here in March and April of 2004. You may have decided to take profits there. If you have a question about whether you should get out when it's so close, when it's such a close call as this one, always look left on your chart and see if there's buying support just to the left. If there is, you want to maybe want to hold that price just a tiny bit. That's for more advanced investors. In January of 2005, you could have gotten bumped out of the stock again. It's quite possible. Now, what will you do? My advice is, if you do stop out of the stock, if you do decide to sell it, if it does go down, watch it. And if you think the stock is still worth being in, if it moves back up over its rising 30-week moving average, you know what? They'll let you buy it back. I called my broker the other day. I said, Fred, if I sell a stock and it starts going up again, can I buy it back? And he said, Toni, anytime you want. So for the price of some commissions, for $20 or $30 or $40 commission, you can do that. But don't you have more peace of mind knowing that you've got your insurance in, that you've got your criteria set, you've got your rules, you've got your guidelines, no matter what. You can certainly buy it back. Suffice to say, Boeing started it up again, and you know what? It's still going at this very minute. I can't tell you where we're going to get out on this one. We're in at 31. The stock has doubled. I don't know where it's going to roll over and come down. We do know one thing, though, don't we? We're definitely going to take our profits when this stock rolls over and makes one or two closes below our 30-week moving average. For right now, though, we're going to enjoy the ride. Let's say for fun that you moved your protective stop loss up just underneath what we call support areas, which are these little low areas. Every single time it stopped and started up again, those are the buyers we call support. you might be one of those buyers. You may decide to add to your position during those times. You may say, there are so many buyers in this area, there's so much demand for Boeing, and actually, doesn't the whole world, and indeed the financial markets, move on supply and demand? There's so much demand in this area, I'm going to add another 2 or 3 or 500 shares to my position. If you had not used the 30-week moving average here, but were just bringing your stop-loss points up underneath, keeping them $1 or 2 underneath those support areas, that's another criteria that's valid, and you wouldn't have gotten stopped out of Boeing. You could have ridden it up and kept going. If it did hit your stop in January, if you did decide to get out in January, you would have bought at 31. You would have taken profits at 50. I really don't see too much wrong with that. You'll never go broke taking a profit. In summary, when you invest, remember, always, always, always evaluate the current market environment. If you're 20 years old, it's okay to buy stocks at the very top of a bull market and wait through the bear market and wait for it to go back up again the rest of your life. But the older you get, we don't have that time. We don't have that time premium. We don't want to wait and lose money before we make money. So please, look at the current market environment. Check all your resources. Check the financial networks. Check the newspapers. Check the financial section of your local newspaper. Kind of get a feel. Read what everybody has to say. And certainly you can figure out and you can pretty well target what the current market environment is and where you think it's going to go from there. Then focus down on the sectors, focus down on the industry groups. What industry are you interested in? Where do you work? What do you know about? That sometimes is a great place to look because you know what's going on in that particular industry. Once you focus on an industry that you like, evaluate your target company's fundamental rating or ranking. Pick one that's a winner. Pick one that's strong right now. After all, if you're picking a baseball team, you're not going to pick the girl with a broken arm. You're not going to pick the guy who's got a broken leg right now to be on your team. You're going to pick the biggest, baddest, strongest person you can get for your team. Just so we want to pick the best stocks, the strongest stocks to invest our money in because our money is hard-earned. When you evaluate your stock's health on a weekly price chart, remember, use an indicator like the one we've used here. Consider using a 30-week moving average, and remember, it must be rising and your stock price must close above it before you purchase shares. If your time frames are shorter and you don't want to stay in a stock that long, put a 20-week moving average on that price chart. You'll find it will follow the price pattern much more closely. You're going to get stopped in and stopped out a lot faster, but that may agree with you. It's almost, think of a moving average as a safety net that keeps you and your money from falling down a lot harder and faster than you want to fall. Once you've evaluated your stock on a price chart, see where it is in relationship to that 30-week moving average. Has it risen and doubled and tripled in price? Maybe you want to wait till it pulls back a little bit. Maybe you want to move on to an alternative stock. Understand, we have more than 9,000 individual stocks out there. More than 9,000 opportunities to invest our money in a high-quality company that can earn us money in the years to come. So let's not pick one that's inferior. Let's not pick the girl with a broken arm and the guy with a broken leg. Let's pick a strong one. And using these 3 criteria and then applying the last one with our 30-week moving average tool, this should help us keep any losses in the stock market very, very low and our gains very, very high. Now, I've said this 100 times already, but we can't make this point enough. Don't forget your insurance. Whenever you purchase a position, whenever you purchase it, your next step is to place your initial protected stop, your insurance, so that if the market directly over the internet, we can call our broker and do it. This is our insurance, and it should be non-negotiable. Don't kid around with yourself. Do it. You're going to be so glad you did. After you get used to looking at price charts and seeing where the buyers come in, where the buyers come in, where the buyers come in, raise your protected stop up so you make sure that you take a profit. So you make absolutely sure that you can't lose money. It'll make you sleep again so much better at night. And finally, remember, have a criteria for exiting your position, whether it's the stop loss that you raise underneath those support areas and you don't want your stock to violate by more than maybe $1, or if it's the 30-week moving average where you say if it closes 1 or 2 times below that 30-week moving average, I'm selling the stock. Whatever that is, hold to it. Whatever it is, hold to it. Develop a system that works for you. Develop a system that agrees with your lifestyle and with your personality. You can't compare yourself to the neighbor next door. It's not going to work. And remember, people will be happy to tell you all about their gains, but they rarely tell you about their losses. And finally, let's look at some overall success strategies that confirm what we've learned during the past hour. Remember, develop an effective plan for buying and selling stocks. A professional football team would not run on the field without a plan. You probably wouldn't get in your car to drive to Bangor, Maine, if you didn't have a map in front of you, because if you don't have a map, you have no idea where you're going to end up. A builder wouldn't start building a house unless he had plans from the architecture. We hope the surgeon doesn't operate without an X-ray, right? So, let's not us jump into the market without a firm and concise plan that's been developed by ourselves, a professional, with really good positive criteria. Spend time with your investments each week. For goodness sakes, look at the newspaper. Watch television a little bit. Where are your stocks trading right now? Where are their price ranges? Where are they in relationship to their 30-week moving average? How is their fundamental data holding up? What is their ranking and rating now? Maybe it's going up, maybe it's going down, but you need to know. Again, the one thing we always keep foremost in our minds and we never, ever forget is to protect our capital at all times. Protect our capital at all times. Even if we don't make a gain, we're way ahead of everybody else if we don't let anything happen to that most precious asset. Remember to diversify your portfolio. Don't put all your eggs in one basket. Choose among different industry groups, biotechnology, financials, pharmaceuticals. Choose different stocks in at least two or three different industries in order to diversify your portfolio. Remember, when one group's going up, the other may be going down. This way, your whole portfolio won't be going down at one time. You'll also want to pay yourself, something I haven't put on our slides here. When you make a really nice profit in a stock, pay yourself, take 10% of that profit and put it in an alternative investment idea. Something strong, something that's entirely out of the stock market, and let it grow there. Always pay yourself before you pay anybody else. I really hope you enjoyed this presentation. Remember, when you get into the stock market, go slowly, go carefully, go wisely. Start on a very small basis in the beginning, and then as you begin to expand your knowledge, expand your discipline, then you can expand your investment horizons. There's something out there for everyone. So keep those thoughts in, and all my best to you.
This concludes Profitable Strategies for the Savvy Stock Market Investor with Toni Turner, the Trader's Educator. We hope you've enjoyed this presentation on investing and trading in the equities market with Toni Turner. To find out more, please visit us at www.tonyturner.com.